The Fed rug pull operation continued this week, with some of the Fed members coming out and saying that they regret their decisions at the last meeting, saying that they should have done 50 basis points instead of the 25 basis points, and rates are going absolutely parabolic. This ended up crashing SPY at the end of the week, but we saw a rally immediately after the CPI report. We went from $412 to start the week all the way up to $416 and ended up dropping to $405 by the end of the week. So how did we get here? This all started with the CPI report coming out Tuesday, where initially the algorithms pumped the stock market when the monthly reading came in at expectations at positive 0.4 versus 0.4 expected. But then actual traders looked at the year-over-year reading coming in at 6.4 instead of 6.2 expected. And then if you really dived a little bit deeper, you saw core services inflation up 7.2% year over year. And if you remember what Fed Chair Powell said in his last meeting with Dr. Rubenstein, he said that if we continue to see services inflation persist, then we're going to have to do more rate hikes than expected. So the market sold off after going to 416 throughout the day and it ended up being in a range. And then the market started to melt up again after we saw a much higher than expected retail sales at 3.0% versus 1.8% expected, and this is up from negative 1.1% last month. So we might be seeing a rebound after the holiday spending slump, or this could be the result of loosening financial conditions thanks to the Fed being very soft with their talks recently. And one of the main things that tightens financial conditions or loosens them is the way that the Fed is talking with the markets. They have a direct impact on where rates are going. So whenever they soften their talk and they're more dovish, rates will go lower, which means that the stock market will go higher, leading to high inflation, like we saw for the month of January, coming in higher than expectations. But if they tighten the financial conditions, rates start to go up. That means that we actually see the disinflation that Powell is wishing for. But after Powell said disinflation 11 times at the last meeting, this ended up softening financial conditions, which is exactly what the Fed doesn't want in order to cool off inflation. So on Wednesday, we ended up selling off initially when we got the hot retail sales, but then ended up recovering and then some, going all the way back up to $416. But then the very next day, we really started to see the pain whenever the producer price index came out at positive 0.7% month over month versus 0.4% expected, and this is up from negative 0.2% the month prior. And this higher cost that these producers are paying is ultimately going to be passed down to the consumers next month, which is possibly going to lead to a higher CPI reading for the next month for January. SPY ended up falling by 1% after this PPI report, and it fell another 1% at one point during Friday's session, all the way down to $405 in order to reach the maximum pain point. And I think that this was just a self-fulfilling prophecy where everybody thought that the max pain point would be reached. It ended up being reached, and then it ended up recovering at the end of the day with SPY closing at 407.26. So that's the macro recap. And then for the earnings recap, the three stocks that I was watching was Coca-Cola, Shopify, and DoorDash. For Coca-Cola, we had positive 47-cent earnings per share versus positive 45 cents expected, so they ended up beating their earnings per share marginally. They ended up beating their revenue at $10.1 billion versus $9.92 billion expected. Initially, their stock ended up pumping in the after hours after this report, but they ended up selling off the very next day in the pre-market, basically back to where it started, and Coca-Cola had a very flat week, which is to be expected. Coca-Cola is not really a growth name, so it's not expected to rise by 10%. And since their earnings per share and revenue came in basically at expectations and a little bit above, they're not going to fall by 10% either. Then for Shopify, this is the exact opposite. We saw their stock fall up by 10% this week after having a positive 7-cent earnings per share versus negative 13 cents expected. And then for the revenue, this came in at $1.7 billion versus $2.21 billion expected. So a huge miss on the revenue, just like I expected in last Sunday's video. And with earnings per share, you can put lipstick on a pig with their share buybacks and employee stock compensation, but you cannot fake revenue. And on top of that, Friday, you got Crazy Aunt Kathy buying up more shares of Shopify, selling out of her Nvidia stake in order to buy it, which is the ultimate inverse trade. And finally, the last earnings of the week was DoorDash, which initially pumped by 10% after the earnings per share came in at negative 165 versus negative 70 cents expected, a miss of around 150%, mostly because they shuffled around a lot of their executives. They got a new CFO, they got a new president, they got a new COO, so basically they're a new company at this point, and they announced some share buybacks. But the problem with their share buybacks is the plan is to spend 34% of their remaining cash balance, $750 billion on share buybacks after a net loss for this company of negative $1.4 billion in 2022. Does this sound dangerous to you? So that's the recap for this week. We talked about the macro, we talked about the earnings, so let's get into what's coming up for the next week. Starting off with the macro. On Monday, this is going to be a holiday, President's Day, Washington's birthday. And then on Tuesday, we're going to have the PMI report, or the Purchasing Managers Index. We have the manufacturing PMI expected to come in at 47.3 versus 48.9. And then we have services PMI, which I think more people are going to be paying attention to, coming in expected at 47.5 versus 46.8 last month. And if we see a huge rise in the services PMI, then this could be signs of more services inflation to come in the future. But if services PMI comes in cooler than expected, then we might see service inflation starting to moderate. That means that rates can start to go down, which means that the growth market and the overall stock market could go up. But if we get a hotter services PMI than expected, then I would expect a decent sell-off from this. After the PMI report on Tuesday, we had the Fed minutes coming out on Wednesday, which is usually a nothing burger because it just restates what was stated in the last meeting. But the Fed could be using this as an opportunity to tighten the financial conditions after the last Fed press conference, where Fed Chair Powell said disinflation 11 times, leading the markets to think that the disinflation process has started. If they end up reversing this sentiment with the Fed minutes on Wednesday, then you could see a decent sell-off. But if there's really no change in tone from the last meeting, then expect this to be a nothing burger and SPY to trade in a range on Wednesday. After Wednesday, we have the jobless claims and the GDP report coming in on Thursday, where GDP is expected to grow 2.9% quarter over quarter, and this is the same that it was expected to do for last month at 2.9%. And then we have the jobless claims expected to see 200,000 job losses versus 194,000 prior. So if the GDP comes in higher than expectations, then the economy might be a little bit too hot, possibly bearish with higher rates in order to cool off the economy. If GDP somehow comes in negative, which will be very unlikely, but if it does happen, that means that we're going to get recession sentiment, which is also bearish. But if we get a lower than expected GDP, I think that could be bullish because the economy is finally starting to cool down, which is what the Fed wants, which means that rates can go lower, stocks can go higher. And then a higher than expected jobless claims means that the labor market is softening, which could be bullish with rates starting to come down. A much higher than expected jobless claims, though, could mean recession, and that would be bearish, obviously. Then a lower than expected jobless claims would be bearish because that means that the Fed's rate hikes aren't being effective. So that would be bearish, rates would go up, stocks would go down. And then finally, Friday, we have the PCE report, which is more inflation data, where the core is expected to come in at 0.4% month over month versus 0.3% prior. And then the year over year reading is expected to come in at positive 4.3% versus 4.4% as of last month. And there's no guesses right now, at least, for regular PCE, so we'll have to wait for that to come in. But the last reading was 5% inflation year over year and 0.1% inflation month over month for the regular PCE reading. If inflation comes in higher than expected, obviously rates are going to have to continue to go up, which means that SPY is going to continue to come down. But if the inflation report comes in better than expected or lower, that means that the S&P 500 could rally by the end of the week. And then finally, the last report of the week, we have the Michigan Economic Report coming in at 10 a.m. on Friday. And everybody's going to have their eyes on the inflation expectation report because last time this came in a lot hotter than expected at positive 4.2%, up from 3.9% the month before for the one-year inflation expectations. And if this continues to rise Inflation is a self-fulfilling prophecy where people are going to go out and buy goods now because they expect prices to continue to go up. They want to save their money, so this will perpetually push inflation higher. But if inflation expectations start to moderate and come down from the high of 4.2% last month, this will be bullish for the markets. This would allow rates to cool off, which would be great for the S&P 500. So that's all the macro events that are coming up this week. And finally, the earnings that we have. Walmart is expected to come in at positive 158 earnings per share. They did 150 last quarter and 153 a year ago. And historically, over the last 8 quarters, they've done an average of 155 earnings per share. I think that they're probably going to either meet or beat on their earnings per share. And then when it comes to their revenue, they're expected to come in at $159 billion in revenue versus $152.88 billion last quarter and $152.9 billion a year ago. And historically, they've done $146.5 billion a quarter for the last 2 years. I think that they're probably going to beat on their revenue just because of rising inflation helping them out. And I think that their earnings per share could actually see a boost in the future because their CEO was threatening to close some of their stores and increase prices due to increased theft. Now, the legitimacy of this, I'm not really sure of, but this could forecast higher earnings per share, which would mean that the guidance would be rising, which would be bullish for Walmart for this week. After that, we have Nvidia coming in at an expected 81-cent earnings per share versus 34 cents last quarter. So they're expected to see a huge rise in the earnings per share from last quarter. And a year ago, they posted a 114 earnings per share. Over the last 8 quarters, they've done an average of 85-cent earnings per share. And I think that they could end up beating or meeting their earnings per share just because of their high earnings over the last few years. They've added a lot of cash balance, which means that they can buy back a lot of their shares, give a lot of employee stock compensation, and this would result in their non-GAAP earnings per share coming in to expectations. But then when it comes to the revenue, this is expected to come in at $6.01 billion versus $5.93 billion last quarter and $7.64 billion a year ago. And over the last 8 quarters, they've done an average of $660. Now, I think that they're probably going to end up missing on the revenue. And if they miss on their revenue, I think that we could see a decent sell-off out of Nvidia. And finally, the last earnings that I'm watching for this week is going to be Moderna, which is expected to come in at 481 earnings per share versus 253 a quarter ago and 11.29 a year ago. So their earnings per share is really starting to drop as people will stop getting COVID shots. And historically, they've done 5.49 earnings per share over the last 8 quarters. Their revenue is expected to come in at $5.09 billion versus last quarter $3.36 billion and $7.21 billion a year ago. And historically, they've done $415 billion in revenue over the last 8 quarters. So the revenue is definitely starting to wane off with less people getting COVID shots. But because of their share buyback program, I think that they could beat or meet on their earnings per share, which will probably be pretty neutral for the stock. But let's see how these stocks are going to trade with my technical analysis. For SPY, it's expected to be in a range of $399.50 to a top of $415. We've got supports at 406.50, 402.46, and 395.78. And then for resistance above where we're trading right now, 411.75, 417.23, and then a Fibonacci retracement at $418.21. So these are the price levels to watch out for this week. And the way that I'm thinking about this is if we get a high services PMI, which is what I'm expecting, then we could be going back down to that 405 mark that everybody was paying attention to last Friday. But if I'm wrong here and the services PMI comes in lower than expectations, we would probably hold above the 406.50 mark. If we see a change in the Fed minutes to tighten financial conditions, then I think that we could easily go to this 402.46 mark. But if there's no change, then I would expect us to trade in a range probably between that 402.46 mark and about $412 or $413. On Thursday, with the GDP and the jobless claims coming in, if we get an extremely high or extremely low jobless claims, I think SPY could go below $402. But if we come in close to expectations within a margin of probably plus or minus 5%, then I would imagine that we would probably stay around $405 and above. And finally, with the PCE report coming out on Thursday, the big event for this week, if this comes in extremely higher than expected, then we're easily going to head below $400 for SPY. If the PCE report is just high, then I would expect us to probably stay above $402. And if the PCE comes in lower than expectations or to expectations, I think that we're probably going to stay above $405. So that's my price analysis for SPY. Now let's get into the earnings plays for Walmart. I've got some supports at 144.51, 142.17, 138.19. We've got resistance at 146.46, 150, and 153.50. And Walmart is expected to be in a range of 139.50 all the way up to 153.50. And the way that I'm thinking about this, if they beat on the revenue, which I think is probably pretty likely, and they get an earnings per share beat, then they're probably going to head above $150. But if they get a revenue beat, but then they miss on their earnings per share, I think this is probably going to head to around $143. We want to see earnings power out of Walmart. And if we don't see that earnings power, I think we're going to head below that 143 mark. And if we're looking at NVIDIA, this has some supports at 209, 203.30, 192.23, and 186.66. For resistance above, we have 219.27, 230.62, and 243. The expected range for NVIDIA this week is $196 all the way up to $232. So about a $20 range in either direction for about a 10% move expected. I think that they're likely to beat or meet on their earnings per share thanks to share buybacks and employee stock compensation. But if they miss on the revenue, I could see this easily going below $209. And then if they miss on both their earnings per share and their revenue, I think this is headed below this 203.30 mark. And finally, the last stock on my watch list, Moderna, currently trading at 166.60. We got some supports at 166.18, 159.50, 153.67, 149, and then above we have resistance at 171.59, 177.10, and 184. The expected range for Moderna is between $153.50 at the bottom and $180 at the very top, which is about a $13 or $14 move, which is around 8%. And I think that they're likely to either meet or beat on their earnings per share, but if they end up missing on the revenue, I think this is probably going to be around $163. And then if they miss on both their earnings per share and the revenue, this could easily be headed down to this $159.50 level and below. So that's my price analysis for Walmart, NVIDIA, Moderna, and SPY. That wraps up the video. Good luck trading this week. Thanks for making all the way to the end of this video. Thank you to my channel members and thank you to my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.